We're now moving to an academic session that's more concerned with the design of CBDC, and we're going to anchor it around a particular idea. And we're delighted to have Maarten van Oordt flying over the ocean from Amsterdam, taking the hit of Amsterdam steeple security, 3-4 hours of waiting, I hear, to be here. So we really appreciate that. The topic of the talk is best before expiring CBDC and loss recovery. The presenter is Maarten van Oordt from Amsterdam, and the discussant will be Katrin Tinn from us.
Thank you, David. Well, thank you for the invitation, for being here, David, Katrin. It's really great to be here. It's definitely worth the wait at Schiphol Airport with security. Really what I want to talk about today is personal loss recovery for offline digital cash. It will be framed in the context of CBDC that applies to any offline digital cash. I've been asked not to make the presentation too technical, so I'll try my best to make it kind of low level. There will be very few equations, so a few. The paper is joint work with Charlie Kahn from the University of Illinois and with Yuzu from the Bank of Canada. Just a little bit about my background. I'm with the Free University of Amsterdam. Last year I was at the Bank of Canada too, and I've been working there for quite a few years with a team of very talented economists to think very carefully about the economics of digital currency. I think the Bank of Canada was one of the few central banks that took a very early strategic decision to try to think very carefully about the economics of CBDC. And this is one of the papers that's kind of still part of that workflow. So best before expiring central bank digital currency and loss recovery, before I come and chat about it, I just want to give you a quick helicopter view of economic research on central bank digital currency. So you kind of see a shift in the economic research agenda on CBDC. Very early research on CBDC was very much on the questions like, should the central bank actually issue a CBDC? Is it beneficial for a country, or is it not beneficial? Is it good for an economy or not? All kinds of questions about disintermediation of banks, financial stability issues, kind of trying to understand that carefully. But what we observe is that over the past years, kind of the agenda has been shifting towards design aspects of CBDC. So people carefully thinking about like one or two aspects of CBDC. So it could be interest rate policies, it could be security of CBDC. Francisco has done some work on that. Thinking about privacy. Katrin, who will be my discussant, has done some work on that too. Programmability of payments, and some research projects based on survey data that look at like a large number of aspects of digital currency at the same time based on survey data. And then this paper will be about implementing expiration dates on offline digital currency in order to facilitate personal loss recovery. So the idea is here, right? If you lose your digital currency, you don't have to worry about it. At some point it expires, and the central bank is going to reimburse that into your online account. So this is diametrically opposed to what some people think about the expiration date of imposing an expiration date of money. It's kind of trying to impose an expiration date to encourage consumers to spend that money really quickly. So, for example, in some countries there have been shopping voucher programs to kind of try to get the country out of a recession, and then these shopping vouchers they expire, say, after 6 months. If you don't spend them, that money is gone. But like for us, it's going to be the opposite. So the money will expire, but we will actually reimburse it into your online account. So other people that have been working on the question like, what if you let money expire to encourage consumers to spend really quickly? It's typically something that consumers don't really like. We're looking at another aspects, like actually using the functionality of the expiration date in order to be able to facilitate loss recovery. Now this is going to be about offline digital currency. So why care about offline payments? Well, in general, there are kind of two considerations for which offline payments are important. The first one we heard about this morning, or both actually, in a talk by McGill. One of them is financial inclusion. So if you think about developing countries, and particularly low-income countries, less than 50% of the population in low-income countries has access to electricity. But in those countries, there are fewer than 60 cell phone subscriptions per 100 citizens. That's all based on World Bank data. So if a CBC that can only be used online becomes the dominant way of making and receiving payments in those countries, that's going to be a substantial issue for a large fraction of the population. But closer to home, we have remote locations, right? In Canada, you don't have everywhere, not everywhere you have as reliable coverage, cell phone coverage, or actually any cell phone coverage. And particularly vulnerable communities can be located in these areas. But then there's a second aspect, which is the resilience of the payment system, which is also an aspect that came back in Miguel's talk. So we can think about cyber attacks or technological failures. I think before the summer, we had an event in Canada with one of the major cell phone operators, Iski, kind of having some issues, causing problems in for debit payments. Natural disasters, so you can think about hurricanes, for example, in the Bahamas, and geopolitical conflicts. So think more recently about local outages in the internet connectivity, for example, in Ukraine. So resilience, financial inclusion for both of those, facilitating offline payments is important, and that's why also central banks are considering to have offline payment functionality built into their CBDCs. Now, typically, if you think about this from a non-technical point of view, you think, okay, so we will make sure that you can also use it offline. But actually, it is not that easy to make this work. And there are actually some fundamental challenges, technological challenges, that you cannot solve with a solution. There's no solution for those. They're just fundamental. And when we were at the Bank of Canada, we were actually talking to the people who were actually working, trying to design these systems. And then we realized that there is kind of this fundamental issue, the fundamental trade-off as to where that is there if you build an offline system. What is that? Well, and where does it come from? Well, basically, if you want to rule out double spending in a system that allows you to make offline payments, you really want to rule out double spending. And basically, what you're causing is that people can very easily lose that money. So why is that? Well, if you want to rule out double spending, and these are requirements, they are not sufficient conditions, but if you want to rule out double spending, then you need to store the balances for offline spending uniquely in a tamper-resistant device. So they must be spent. So what does it mean? You store these balances in one device. You don't store them in multiple devices. So balance must be stored at one location. And the second is you need to separate those funds that can be spent with that device in an offline environment from the funds that can be spent without that device. So why is this? Well, just a quick sketch of the proof. I'm going just to look at the converse. So here's the Bank of Canada in the middle. It runs a CBDC system. There are stores where you can pay, and some are out there in the woods and they don't have an internet connection, so you don't see a dashed line. And if you want to pay in a store which has an internet connection, it's going to be really easy. Like the store will check, like, does the person have the money? Money hasn't been transferred, and so it's kind of very easy thing to do. But then when you're out there in the woods, you cannot do this. So basically, people have to show up with a device with funds stored in it. So the first claim I made is it needs to be stored, like you need to store the funds for offline spending on only one device, not in multiple devices. Why is that? Well, if you store it in multiple devices, I give one device with $100 to Professor Schumacher, and I keep one device with the same $100 in my own pocket. Both of us go at the same time to an offline store. They cannot check whether the money has been spent because they're offline. So we can double spend that amount. That facilitates double spending. The second claim that I made is that you also need to separate the balances that you can spend with that device from the balance that you can spend without the device. Why is that? Well, otherwise, I can first put $100 on a device, and then I can go to Amazon, and I can say to Amazon, I want to spend those $100 on this product, and then I go with this device with still the $100 offline dollars stored on it, and I can go to an offline store and spend money there. There's no way for the offline store, by definition, to actually check whether I spent the money on it. So there are two requirements. Basically, you need to store the balance uniquely in a tamper-resistant device, and secondly, you need to separate those funds that can be spent with the device from those that can be spent without that device. But that's an issue, because now you've got funds stored in a single device and are not stored anywhere else. So what is the issue there? You're creating a single point of failure for consumers. If I lose that device with these offline funds, basically it impairs my ability to spend these funds in the future. You basically lose the funds. So it doesn't matter whether you lose the funds because you lose them accidentally, or whether your device is broken, or whether it's stolen. It's kind of just the money is gone, just like with physical cash. And basically what we're kind of trying to ask, like if there's this fundamental issue, if you want to facilitate offline payments, if there's this fundamental technical limitation, can we somehow reduce the cost of digital cash losses? Well, one thing that you could do is, let's say suppose you have a phone and suppose it is broken and have $1,000 stored on it. We could say, well, you can send in your device to the central bank. Scott Henry here is not going to be very happy with that. He's going to have a lot of broken phones on his desk. It's not a very practical solution. And you could try to retrieve these funds from these broken phones, which is very much actually what central banks are already doing if you have traces of mutilated banknotes, for example. But it's not going to be very useful in a situation where you lost your phone, or where your phone is stolen. So it's not a very practical solution. It also doesn't work for all instances. So is there something else? Because this is digital that makes it kind of a little bit more convenient. And then what we are kind of saying is, well, suppose that on these offline funds on your phone or on your payment card, suppose they come with an expiration date. And then once that money expires, which could be the case because you didn't spend it, but it could also be the case because you actually lost it, or because your device is no longer working, or it was stolen. Suppose that after they expire, we immediately reimburse that money to your online account. That's basically kind of what we're analyzing. We're kind of actually analyzing that in an economic model. So, because if you think about it, it's like, well, what would be the optimal expiration date? What are actually trade-offs that are there kind of in the background? So basically, what we're looking at is, well, suppose we look at a solution, what would actually be the best way to implement that, and what do we learn? So just the idea in a nutshell, just to make it a little bit more visual, this could be your CBDC app in the future, just the mock screen, not any design. So this is your CBDC app. It has $275 on it. And there would be kind of this field that you could fill out, which would say like, well, how much of that do you want to hold as an offline balance, so that you can pay it whenever you're offline. So that would be kind of standard, but the issue is like, well, once you put a number there, that money is really stored on that device. So if you lose that device or it breaks down, money is gone. But it could come with this option saying enable loss recovery. And then there would be a star added to these balances, and it says, well, the time to expiration for these offline balances is another 180 days. Of course, kind of you could automatically refresh that, say every day, whenever you're online. But that's kind of the basic idea. Okay, so expired cash gets reimbursed. But actually one thing, and now at this point, you might feel, oh, this sounds pretty appealing, but I actually jumped over a problem. Which I didn't really tell about. It's really about who gets the money back, who lost the cash. Because if you're spending money in an offline environment, well, the central bank is not observing whether any transactions are going on there. So you've got to think about, well, who is the central bank going to reimburse for any money that expires and remains unspent? So that's really what where you can make choices. So we're considering in our paper two particular information structures, and there are more that you could think. But one is what we call a higher privacy model, or no information sharing, the no information sharing model, which basically, well, whenever you are syncing your device, perhaps because you want to update, refresh the expiration date of your money or whatsoever, whenever you are doing that, your device will not tell the central bank anything about your past spending. So that's kind of one potential model. So then if you accept offline money, of course, there's no way that the central bank knows that you actually accepted that money, unless you go to the central bank before the expiration date to actually claim that money. So you can think about that, well, it's very much like a check system, like you can accept a check, but if you never show up at the bank to actually cash in the check, you still don't have the money, right? And so that's similar how this system would work. It's like, well, I can pay offline, but still the onus is still on the person who accepts the money to actually go to the central bank before the expiration date to cash in that money. And if they fail to do so, I would get it back. The other one is a lower privacy model. So basically it works pretty much the same, except that whenever I'm online as a consumer, my device will actually tell exactly to the central bank what I've done while being offline. So if you think about it, it's kind of a situation where say if the shopkeeper fails to deposit the money, perhaps his system has broken down, perhaps he lost the money, then it could be the case that the shopkeeper still gets the money because my device is actually telling the central bank, well, Maarten, pay this money to this store. But actually what you observe when you're kind of looking at this particular model is that there will be actually some strategic choice by consumers, which I won't discuss during this presentation. Certainly not 5 minutes left. So just a summary of the results, a quick summary. So what do we find in our analysis? Loss recovery with an expiration date, it could have a substantial positive impact on the demand for offline balances and welfare during situations where people are offline. It is less costly to err on the long side with the expiration date than erring on the short side. And more information sharing between consumers and the central bank, it can make loss recovery more targeted, but it has an ambiguous impact on social work. So just really quickly, an outline. I have only 5 minutes left, I've been told. So I'm just going to jump over the small model. I'm just going to tell you like really quickly what are the ingredients and then kind of tell you what the results are. So the small model is really just to illustrate some of the key trade-offs. There's cash in a model, which is basically just digital offline money, which could be stored value in a payment card, or could be stored value in a secure smartphone chip. And basically what the cash does in the model, it ensures your consumption. It allows you to spend while you're offline. Because there are basically two types of money in a model. There's offline digital cash, which you can spend offline and online. And there is online CBDC that you can spend when you're just in an online situation. It could be just commercial bank money. So the online balances, they pay some interest. It could be zero. Cash does not pay any interest. When at the start of the model, kind of, you have to think as a consumer, how much cash am I going to carry? And you don't know exactly how much you want to spend. It could be little, could be a lot, but basically you have to make that choice. But then basically, after you decide how much cash to carry, like there are two potential shocks that can materialize. First of all, there could be an outage, in which case you can only spend offline cash and you cannot spend your online money. But it could also happen to you that you lose your money, which can happen with a probability delta. Now, you want to buy stuff, which if there's no outage, you can use both online balances and cash, but if there's the outage, you can only spend cash. And at t equals 2, there's the outage stops, which is a very simple model. And producers, they can lose their money too. And basically, at the end of the model, like everybody cares how much money they have. So suppose you impose no expiration date in this model. So what happens? Well, as a consumer, you're kind of trading off. You want to spend during an outage, during an offline period, ideally. So you want to insure for that situation, but there's also a cost of doing so. So what's the cost? Well, it is the cost, the lost interest. For every dollar that you carry cash, you're losing some interest on your bank account or savings account. But there's something else to it too, which is like the probability that you actually lose that money. So you can think about like, well, perhaps you, depending kind of how this works out for you, kind of could be that you hold enough money for any type of consumption pattern, but it could also be that you kind of economize on your cash holdings, in which case like consumption will be affected by outages, which is something we want to avoid. So that's if there's no expiration date. If there's a very quick expiration date, so basically what happens then in the model, well, if there's an outage, I could spend my offline cash and give it to the shopkeeper. But the thing is that the money will expire before the shopkeeper can actually go to the central bank. So it's not a very good idea for the shopkeeper to actually accept that money. So there's a good reason for the shopkeeper actually to avoid that money at all. So you're kind of, by implementing expiration date, you're making things worse, because before I could use cash that didn't expire, but now I cannot use cash at all. So it's kind of, you're like in an environment where there's no cash. So it's making matters worse. And then you can think about like a long expiration date, say 2 periods. What happens then in a model? Well, everything is the same as before, but now the cost of carrying cash has become substantially cheaper, because now the cost of carrying cash is the interest rate that you lose, which is the same as before. But if you lose money, which happens with probability delta, you're not losing $1 for every dollar lost, but you only experience the inconvenience of not being able to access that money for 2 periods, because it expires only after 2 periods. So that's why we have 1 minus beta, which is the discount factor to the power 2, because it expires in 2 periods. Okay, very simple model. But it kind of helps us to explain like the key trade-offs if you're thinking about an optimal expiration date. Now, we also have a more complex model and by calibrating that model, we get kind of a rough idea about potential impact of introducing expiration date to kind of the optimal expiration date. So there are a few parameters in the model, and I just want to kind of quickly run through them, kind of just to give you a feeling about what's important in the model. So one is, how impatient are people, the discount factor. Second, risk aversion, how bad it is for people not to be able to consume during outages or during periods. Then the loss probability, what's the probability that you actually lose your money? So we don't have any good past economic research on this, so we did a small survey to actually get a good idea of the probability. So if you store money on a payment card, it seems that based on that small survey that we did, you lose that deals balance about 1 every 6 years on average as a consumer. Or if you for stored value in phones turns out to be lower. Apparently people have fewer issues with their phones, something like once every 12 years. But still, a probability of 8% per year. Okay, so this chart, it shows you the amount of cash people would be willing to carry for different expiration dates as a function of the expiration date. So I'm just showing the red card. So just 3 quick key lessons from this chart. So on the horizontal axis here, you have the number of days. So how many days it's going to last for the money to expire. On the vertical axis, there is how much cash are people willing to carry as a multiple of their daily spending. So this is calibrated based on US data. So people in the US, for money that doesn't expire, they carry about, or they have about, both at home and in their pockets, about 3.5 times their daily spending, about $180. So that's the red dashed line. So if the expiration date is like infinitely far in the future, you get to the red dashed line. So that's kind of why it's slowly sloping downwards. So one thing you observe is that the blue line is far above the red dashed line, which means if you implement an expiration date above for offline digital cash, it will substantially increase the potential demand for that offline digital cash. Like the numbers, they of course very much matter for on the precise calibration. So you have to take this with a little bit of a grain of salt. But for any calibration, you observe that it's substantially above. And then secondly, it starts from 0. Like in a very simple model, if it expires really quickly, it becomes useless. And then it quickly increases, and then it very slowly decreases. So why is that? Where does that very slow decrease come from? Well, it's just like if you extend the expiration date by just 1 more day, basically what happens, well, it takes 1 day longer before you get your money reimbursed. So kind of the slope here of the blue curve, it depends very much on the discount factor. So 0.96, if you choose a lower, if you make people more impatient, this line becomes sloping downward faster. But still, what you always get is kind of a very smooth decline. So what you always find is it's better to err as a policymaker on setting an expiration date that's too long rather than too short. And that is really what I want to conclude with. Sorry for going to 3 minutes outdated. Thank you very much for your attention.
Okay, so thank you for us inviting to discuss the paper. But so this one is about features of digital, so central bank digital currencies that one might want to have. And the way I would like to go in this discussion is to start with the questions that is obviously going to feature a lot today. Why issue CBDC? And many people can have many takes on it, but one take on it is perhaps we can issue something that is better than what exists. So for example, when it comes to privacy and account money, like the bank payments is not particularly private, we might trust banks to not say the information to others, but obviously there is a lot of innovation going on. So imagine Facebook's Libra DM, if it would have been issued combined with NFTs and all data on everybody's purchases and some meta-page being like telling about people's personas and what kind of unintended consequences we might get from that. Of course, physical cash is very private, but it's also not very convenient. But another question is that if already one thinks of anything that is digital by nature, so why not benefit from the digital records, which is a bit in tension with this privacy question about the fact that, as Alfred was telling as well, maybe we want to issue smart contracts on it. Maybe we want to make lending more available to the agents in the economy rather than worry about it, making it less available via the banks and so on. And whether these things are in conflict or solvable together, I'm happy to discuss further. But what this paper is about is thinking about another feature that could be better in this digital money, because physical cash can be lost, bitcoins can be lost and never used. Account money is easy to recover. But then again, we have this privacy concerns. Okay, so overall, this is a very similar picture as you saw earlier. So what the paper is proposing is to have this innovative feature included, which is a digital cash that expires, and in particularly gets reimbursed after it expires. So it's not like people lose a cash, it's just that if somebody has, like, say, this account balances and has put $900 of this offline, then, for example, they know that this cash is gonna be expiring in October 10, so it can be spent potentially more privately here as well. And if it is not spent, it just hops back to the account. We could also think of, like, and we'll have questions about it later, like a couple of them with different expiry dates. It doesn't happen in the model, but could be interesting as well. Okay, so overall, what the paper highlights is that there is possibility to have digital cash or expiring cash that is superior to physical cash because it cannot be lost. It is also helping the program of payments without electricity and network coverage, as well as remote areas. And one needs to keep in mind that worldwide unbanked population is probably around 30%, and even in countries like Canada, it is 6%. So it's not negligible part of individuals, which the first keynote speech was emphasizing as well, could be increasingly excluded from this digital economy. Okay, and so this is the case. So I'm not going to describe again like the model in detail because Maarten already did it, but essentially the risk neutral consumers and producers interact in this economy. And there are like a couple of things that can happen in this environment. So the physical or offline digital cash can be lost either by consumers or producers. There may be power outages, and consumers are essentially choosing how much of these things to hold. and what means of payments to use. So they have some trade-offs, natural ones that, for example, don't earn interest from the cash or cash plus. Okay, and then there is also a central bank who benefits from senior income and saving on interest rate on this money, so that is important for the welfare effects that is in the interest of this paper. And what are the key findings is that we shouldn't probably be very surprised that the traditional cash is worse compared to this expiring cash. And if one needs to decide the optimal expiry date, it's better to make it longer. So it's better to err towards longer sides than a shorter side. What also more funnily happens in the background of the model is fact that if you are thinking of a consumer and producer both being offline, then the producer who might lose a device as well is the one that actually can get in trouble because of this expiring feature. Okay? Because even so, the system is designed to avoid double spend. Sometimes you are unlucky and you can double spend, because I can go and buy something in a forest, and if the shop located in the forest is not reimbursing, it's not depositing it fast enough, then it will be me who got whatever I bought in the forest, and I will be able to spend it again because it will be having bounce back on my account. And there are also nice endogenous things that give a reason of why, for example, for this sort of reasons, the producer would set prices higher, for example, than the ones paid with an account money. Okay, so then the question is, okay, would it be useful to have information exchange here? So now we are going against privacy again, and we are letting this offline device to be sending to the central bank, for example, what the consumer has spent, and then potentially give money back to the right producer. And now we are undoing a lot of things there. And what the paper finds that even in this nice finite settings, the welfare effects of trying to help the producer here is ambiguous, because consumer may still strategically go offline if it benefits them. Okay, so we have this case. So overall, it is a very nice paper to read, because the model is stylized and we can learn very many interesting observations from there. And so given that, I will have 2 comments, 2 questions, and a final question, I guess, for overall. Okay. So we also have a bit of questions on how realistic is to worry about the people that are offline in the forest, the ones that get in trouble in the model. Because I guess that when we are thinking of unbanked problems, and it's more reasonable to maybe think that it's some consumers who don't always have access, but maybe a shop still can figure out how to have an internet access. Or if it is such a small place where it is not possible, then maybe some reputation effects would solve this problem. So overall, one of the reasons why the producer is in trouble in the models of this, because the paper also assumes slow settlement. So this is something that would be made better with technology. But of course, this problem would remain if there is power outages and this actual physical things about which we can't do anything about it. Second one is when looking at this model, there is another benefits that one could have if we are getting back to the idea of smart contracts. And that is if one thinks about this expiring feature of the cash, it could help to get some transactions on chain in this language, because normally we might worry that if we are thinking of some smart contract where we need to see money received, why wouldn't people go and, if it is in their interest, like the firms, say, why wouldn't they still accept some cash payments and hide this payment from whoever is contracting with them via internet, via smart contract? And naturally, when we are thinking of this expiring cash, that will give you incentives to record the sale online, because otherwise it's going to be gone. So in that sense, the story in this model of having pressure to be spending faster, actually it is good for the producers to be put in there. So I think it is a nice extra effects that this model would imply. Okay. And yeah, so related to that, I have to you. I have two questions. So one is that in the model, there is one expiring digital cash voucher, so it's like one amount. But one would think that because there are different reasons of wanting to go offline, maybe it's few, maybe for precautionary purposes, you want to have something which expires very slowly, and something that is like useful in the case that you're going to the forest or something like that. And so this is one question. And yeah, so this is also another question being that should this expiry date be a built-in feature, in your opinion, or should it be a consumer's choice? And whether the consumers would consider it a nuisance to be constantly managing their expiry dates, especially if it is many, or it is something that would be interesting. But also the questions that if it is not a built-in feature, like would they actually have incentives to make choice, socially optimal choices regarding it. So that is a question to debate about. And going back to my initial points, that maybe one reason to think about issuing CBDC is because there exist cash plus file features that are desirable. And then we can ask who would be best to design these cash plus features? Is it central banks, technology firms, financial institutions, or crypto community? And obviously the crypto community is going to continue innovating. I think that when it comes to some large technology firms, like there is too many worries about privacy, so I'm not sure that even the Gen Z students would necessarily like it, and then net zero, so I will have it finished. Thank you.
A few short minutes for questions from the audience. Yeah, Alfred.
So in my CBDC proposal that I wrote for the Bank of Canada, the computer scientists and the team convinced me that you can avoid this double spending problem and keep privacy by giving some partial identity information with every spend. So if you spend it once, nobody knows who you are. If you spend it twice, there's enough information on you in the system that they can hunt you down and send the police after you. So maybe there is a technological way to address this double spending problem and keep privacy alive.
Well, like it's a little bit like writing checks, right? So if you think about when you write a check, like the check allows you to double spend. Because you can, on the same bank balance, you can write multiple checks. But then if you do it, then people get after you.
Yeah, but the check itself is not private, right? And here you keep privacy and double spending.
Potentially, yeah. So you can go for a check system. Kind of what we are looking at is really about a situation where we say, well, we really want to have a situation where we cannot allow for double spending. So that's kind of a presumption there. And then we kind of start from that model. One reason why you might want to think about the situation where you don't want to allow for any double spending is, well, if you think about the example with the checkbook, is you can exclude certain consumers from it. Because you can simply say something, well, we have seen some fraud with your checkbook for quite a while, and now we're no longer going to issue a checkbook to you. But as a central bank, you really cannot do it. Like even if you're a drug dealer, you need to be able to buy food for your kids. And so you cannot really exclude people from the payment system. So that could be a reason, like the fact that you don't want to exclude people from the payment system. Perhaps that's one reason why you might want to go for a system where there's absolutely no double spending. Your points well.
Thank you. Related question with regards to technology. It seems that the main goal of such a system is disaster recovery and making sure that there's ways to recover and avoid double spending. Have you considered other technological solutions like key sharding and MPC to allow for disaster recovery in an offline world without introducing an expiry concept?
Well, it's easy to, so there are two types of systems that allow for double spending and systems that do not allow for double spending. But any system that does not allow for double spending will if facilitators of offline payments will always impose on individuals that they will be able to lose their cash by just losing devices. So kind of, you can certainly kind of create a digital system that does not have this expiration date.
Like for example, NPCs allows for recoveries of key without, when you lose your phone, for example. By introducing third party and key sharding, meaning that you can reconstruct a private key out of it. So I'm just trying to think, just trying to understand, is there a, and was that part of the thought process to look for distributed technology solution that achieves the objective of disaster recovery without assuming that if you lose your phone, let's say you lose your key.
It's not just disaster recovery, it's actually that you are during a disaster, that you're still being able to spend. So for the key recovery protocol that you're kind of proposing, or that you're referring to, it requires you to be online. So, but fair enough.
Right. So at this point, we'd be facing the very real trade-off that every extra question is a minute less at lunch. So I think the verdict, what's the verdict? One more question? Sure. I think we only have a short lunch break, because the even worse trade-off would be the third bite from your sandwich versus the first sentence of Daryl after lunch. And I think that's a no-brainer. So we're going to go for lunch. We have a good hour. We'll go to the faculty club. For those of you not familiar, it's out of the building left, third building on the left. Maybe my colleagues can sort of help the crowd, and we have to go up on the third floor. See you in an hour.